Hello and welcome. If you've ever felt overwhelmed by money, you're not alone. It can feel like you're juggling a dozen different things at once. There's your paycheck, your rent or mortgage, car payments, credit card bills, saving for a vacation, and that little voice in the back of your head wondering if you're doing enough for retirement.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
It's complicated, and sometimes, it feels like all these financial pieces are disconnected, floating around without a clear plan. This is where the concept of 360 finance comes in. In this series, we're going to embark on an educational journey to understand this powerful idea. And in this first chapter, we'll answer the most fundamental questions. What is 360 finance really? And more importantly, why should it matter to you? First, let's be very clear about what 360 finance is not. It's not the name of a specific bank, a trendy new app, or a get-rich-quick scheme. It is not a product you can buy. Instead, think of it as a philosophy or a framework. The 360 stands for 360 degrees, a full circle. It's about looking at your entire financial life as one interconnected system, rather than a bunch of separate, unrelated parts. Imagine you're the captain of a ship. To navigate safely and reach your destination, you can't just stare at the speedometer. You need to check your fuel level, monitor the engine status, look at the weather radar, and consult your map. All these components work together. Focusing on only one thing, like how fast you're going, could lead you straight into a storm or leave you stranded with an empty fuel tank. Your financial life works the exact same way. Focusing only on your stock market investments while ignoring high-interest credit card debt is like flooring the gas pedal while the ship is taking on water. Paying off debt aggressively but having $0 in an emergency fund is like having a perfectly clean engine but no life rafts. The 360 finance approach encourages you to step back and look at the entire dashboard. It's the practice of understanding how your earning, spending, saving, borrowing, and investing all influence each other to create your overall financial health. It's about making conscious decisions where every part of your financial plan supports the others. So, what are the key components of this 360-degree view? While we will dedicate future chapters to each of these areas, let's briefly introduce the core pillars. First, there's your cash flow and budgeting. This is the absolute foundation. It's about understanding what money is coming in and where it's going out. It's not about restriction, it's about awareness. A 360-degree view means your budget isn't just about paying bills, but also about intentionally directing money towards your other financial goals. Next, we have debt management. In the United States, debt is a common tool, from student loans and mortgages to credit cards. The 360 approach doesn't just say debt is bad. Instead, it asks strategic questions. Which debts have the highest interest rates? How does your debt repayment plan affect your ability to save or invest? It's about creating a smart strategy to manage and reduce debt in a way that benefits your entire financial picture. Then comes your savings and emergency fund. This is your financial safety net. Life is unpredictable. A car breaks down, a medical issue arises, or a job loss occurs. The 360 view recognizes that without a solid emergency fund, any unexpected event can completely derail your other goals, forcing you into high-interest debt and setting you back months, or even years. Of course, a huge piece of the puzzle is investing and retirement planning. This is about growing your money for the long term. A 360 perspective here means your investment strategy should align with your age, your risk tolerance, and your specific goals, like retirement. It's not about chasing hot stock tips. It's about a consistent, disciplined approach to building wealth for your future self. Another critical pillar is insurance and asset protection. This is the defensive side of your financial plan. Think of it as protecting everything you're working so hard to build. This includes health insurance, life insurance, disability insurance, and coverage for your home and auto. A 360 view ensures you have the right kind of protection, so that one unfortunate event doesn't wipe out your financial progress. Finally, all of these pillars come together to support your major life goals. Do you want to buy a house? Pay for a child's education? Travel the world? Start a business? The 360 finance approach connects your daily financial habits directly to these big, meaningful aspirations. It turns your financial plan from a boring spreadsheet into a roadmap to the life you want to live. Now, we need to pause for a very important disclaimer. This series and all the information provided within it is for informational and educational purposes only. We are exploring concepts and frameworks. We are not providing financial, investment, legal, or tax advice. Personal finance is deeply personal. The rules, regulations, and best strategies can vary widely based on your individual circumstances, your location, and current laws. Therefore, it is essential to consult with qualified professionals, like a certified financial planner, a certified public accountant, or an attorney, who can provide advice tailored specifically to your situation. Think of this series as a way to become more informed, so you can ask smarter questions and have more productive conversations with those experts. So, why should you care about this 360 finance concept? The simple answer is clarity and control. When you see your finances as an interconnected system, the fog begins to clear. You stop making decisions in a vacuum. For example, instead of just asking, should I invest in this stock? You start asking, given my current debt level and my emergency fund status, does making this investment align with my overall plan and risk tolerance? It's a much more powerful question. This approach helps reduce financial anxiety. Much of the stress around money comes from the unknown. By adopting a 360 view, you replace that uncertainty with a clear picture. You know where your money is going, you have a plan for emergencies, and you are actively working towards your future. That knowledge brings a profound sense of peace and empowerment. Ultimately, the 360 Finance Framework is about aligning your money with your values and your life. It's a tool to help ensure that your financial engine is not just running, but that it's taking you exactly where you want to go. To recap this chapter, 360 Finance is not a product, but a holistic mindset. It's about viewing your earning, spending, saving, debt, and investments as one interconnected system. It helps you gain clarity, reduce stress, and take control of your financial journey. Thank you for joining me for this introduction. I hope it has provided a clear starting point for what promises to be an enlightening series. In our next chapter, we will dive deep into the absolute bedrock of any solid financial plan, budgeting and cash flow. We'll explore practical methods to understand where your money is truly going, without judgment, and how to create a simple plan that works for you. Hello and welcome back. In our last chapter, we introduced the concept of 360 finance, the idea of looking at your entire financial life as one interconnected system. We talked about how this bird's-eye view can bring clarity and reduce stress. Today, we're going to lay the very first stone, the foundation upon which your entire financial house will be built. We're talking about budgeting and cash flow. Now I know what some of you might be thinking. The word budget can bring up some negative feelings. It might sound restrictive, like a financial diet where you have to give up everything you enjoy. But I want to challenge that perspective today. A budget is not a set of chains. It's a blueprint. It's a plan for your money. Think of it this way. You wouldn't build a house without a blueprint, and you wouldn't start a road trip without a GPS. A budget is simply a tool that gives your money direction. It's about being intentional and telling your money where to go, instead of wondering where it went. The goal isn't restriction, it's awareness. So where do we begin? The first step in creating any plan is to know your starting point. This means for a short period, maybe just 1 month, your only job is to become an observer. Your mission is to track your spending and find out where your money is actually going. This is a no-judgment zone. This is incredibly important. The purpose of this exercise is not to make you feel guilty about buying coffee or subscribing to a streaming service. It is simply to gather data. You are a financial detective looking for clues, not a judge delivering a verdict. So, how do you track this information? There is no single right way. The best method is the one you will actually stick with. Let's explore a few popular approaches. First, there's the analog method. This could be a simple notebook and a pen, or a basic spreadsheet on your computer. Every time you spend money, you write it down, the date, the amount, and what it was for. This method is very hands-on, and can make you feel more connected to your spending habits because you are physically recording every transaction. Second, there's the digital method, using budgeting apps. There are many apps and software platforms designed to make this process easier. You can securely link your bank accounts and credit cards, and the app will automatically import and categorize your transactions. This saves a lot of time, and can give you clear visual charts and graphs showing where your money is going. It's a great option if you're comfortable with technology and want an automated system. A third option is the bank statement review. If the idea of daily tracking feels overwhelming, start here. At the end of the month, print out your bank and credit card statements. Then, with a few different colored highlighters, go through and categorize every single transaction. For example, green for groceries, yellow for gas, pink for entertainment, and so on. This isn't as precise as daily tracking, but it's a fantastic first step to get a general picture. After a month of tracking, you'll have your data. You'll have a clear list of where your money went. Now what? This is where we turn that data into a plan using a simple framework. A very popular and beginner-friendly guideline is the 50/30/20 rule. Again, please remember this is a guideline, not a strict law. It's a starting point to help you analyze your spending and create a balanced plan. Here's how it breaks down. 50% of your after-tax income should go towards your needs. Needs are the absolute essentials you must pay to live. This includes things like rent or mortgage payments, utility bills like electricity and water, essential groceries, transportation to get to work, and insurance payments. These are the have-to-haves. 30% of your income can go towards your wants. Wants are things that improve your quality of life, but aren't essential for survival. This category includes dining out, entertainment like movies or concerts, hobbies, gym memberships, streaming subscriptions, and non-essential shopping. This is the fun category that makes life enjoyable. The final 20% is arguably the most important for your future self. This portion should go towards savings and debt repayment. This includes building up your emergency fund, contributing to a retirement account like a 401k or an IRA, and making extra payments on high-interest debt like credit cards or personal loans. Every dollar in this category is a dollar that's working to build your financial security and wealth. So you take the spending data you tracked and see how it lines up with these percentages. You might find that your needs are taking up 70% of your income, or maybe your wants are closer to 50%. Again, don't panic or judge. This is just information. If your numbers are far from the guideline, it simply highlights areas where you might want to make changes. For example, if your wants are very high, you can look through your spending and decide what was truly worth it, and what you could cut back on without losing much happiness. This exercise naturally leads us to the concept of cash flow. Cash flow is the term for the net amount of cash moving into and out of your finances. If you have more money coming in from your paycheck than you have going out for your expenses, you have a positive cash flow. If you're spending more than you earn each month, you have a negative cash flow, which usually means you're taking on debt. The entire goal of a budget is to help you create a sustainable positive cash flow. By understanding and adjusting your spending in the needs and wants categories, you can free up more money to direct towards that powerful 20% category for savings and debt repayment. Even small changes can make a big difference over time. Finding an extra $50 a month by cutting back on a few subscriptions might not seem like much, but that's $600 a year you can put toward your financial goals. As we wrap up, let's remember that a budget is a living document. It will change as your income changes or as your life goals shift. The key is to be flexible and give yourself grace. The perfect budget doesn't exist. The best budget is simply the one that you can stick with consistently. To recap today's chapter, budgeting is not about restriction. It's about awareness and creating a plan for your money. The first step is to track your spending for a month in a no-judgment zone. Then you can use a simple guideline like the 50/30/20 rule to analyze your spending and create a balanced plan. The ultimate goal is to create a positive cash flow that allows you to aggressively pursue your savings and debt repayment goals. Thank you for joining me. Now that we understand the importance of setting aside that 20%, our next chapter will focus on the very first destination for those dollars: building your financial safety net. We will explore the critical importance of an emergency fund, what it is, how much you need, and the best ways to build one. Hello and welcome back to our series on 360 Finance. In the last chapter, we created a blueprint for our money by exploring the concepts of budgeting and cash flow. We talked about the 50/30/20 guideline, where 20% of your income is directed towards savings and debt repayment. Today, we're going to focus on the absolute first priority for that 20%, building your financial safety net, more commonly known as an emergency fund. If budgeting is the foundation of your financial house, then an emergency fund is your fire extinguisher, your first aid kit, and your security system all rolled into one. It's a sum of money set aside specifically to handle major, unexpected expenses without completely derailing your life. Life is unpredictable. Even with the best plan, things can go wrong. A car transmission can fail. A roof can start leaking. An unexpected medical bill can arrive in the mail, or worst of all, you could face a sudden job loss. These are not just inconveniences, they are financial shocks. Without a safety net, these shocks can force you to make difficult choices, like taking on high-interest credit card debt, borrowing from family, or even liquidating long-term investments that were meant for your retirement. An emergency fund is your buffer. It's the cushion that separates you from financial chaos. It provides peace of mind, knowing that if a crisis hits, you have dedicated resources ready to deploy. This isn't your vacation fund or your new car fund. This money has only one job: to protect you and your long-term goals when the unexpected happens. So the big question is, how much do you need in an emergency fund? A widely cited rule of thumb in the personal finance community is to have 3 to 6 months worth of essential living expenses saved. Let's break down what that means. Essential living expenses are the core costs you identified in the needs category from our last chapter. This includes your rent or mortgage, utilities, food, transportation, and insurance premiums. It does not include discretionary spending like entertainment, dining out, or subscriptions. To calculate this, you would add up your essential monthly costs and multiply that number by 3, and then by 6, to get your range. For example, if your essential expenses are $2,000 per month, a target emergency fund would be between $6,000 and $12,000. Now that number can sound incredibly intimidating, especially if you're just starting out. It's important to view this as a long-term goal, not something you need to achieve overnight. The key is to start no matter how small. Any amount of emergency savings is infinitely better than zero. The exact amount you should aim for within that 3 to 6 month range depends on your personal circumstances. If you have a very stable job in a high-demand field and a second income in your household, you might feel comfortable closer to the 3-month mark. On the other hand, if you are self-employed, work on commission, have a single income, or have dependents, aiming for 6 months or even more might be a more prudent goal. This is about your personal risk tolerance. So, how do you actually build this fund? You start small and you stay consistent. The most effective strategy is to automate it. Go back to the budget you created. Decide on a realistic amount you can set aside from each paycheck. It could be $25, $50, $100, whatever works for you. Then, set up an automatic transfer from your checking account to a separate savings account. Schedule this transfer to happen the day you get paid. This pay yourself first method ensures that the money is saved before you even have a chance to spend it. Out of sight, out of mind. Another strategy is to direct any unexpected income or windfalls directly into your emergency fund. This could be a tax refund, a work bonus, or a cash gift. It's tempting to spend this extra money, but using it to build your safety net is one of the most powerful financial moves you can make. You can also find ways to temporarily reduce expenses. Maybe you can pause a few streaming services for a couple of months, or commit to cooking at home more often. The money you save can be used to accelerate your emergency fund savings. Once you hit your initial goal, you can reintroduce those expenses if you wish. Now, where should you keep this money? The two most important characteristics of an emergency fund are safety and accessibility. You want the money to be safe, meaning it shouldn't be invested in the stock market or other assets that can lose value. The purpose of this money is not to generate high returns. Its purpose is preservation and protection. You also need it to be accessible or liquid. This means you can get to it quickly in a true emergency, ideally within 1 or 2 business days, without paying any penalties. For these reasons, a high-yield savings account is often considered an ideal place for an emergency fund. These accounts are typically offered by online banks, are FDIC insured up to the legal limit, and offer a higher interest rate than a traditional brick-and-mortar bank savings account. This allows your money to grow slightly while remaining safe and accessible. It's also a great idea to keep this account separate from your regular checking account. This creates a psychological barrier, making you less likely to dip into it for non-emergencies. If you see the money every time you log into your main banking app, the temptation to use it for a weekend sale can be strong. A quick but important final point. Remember to replenish the fund. If you have to use a portion of your emergency fund for a car repair, that's exactly what it's there for. But once the crisis has passed, your next financial priority should be to pause other savings goals and rebuild that fund back to its target level. In summary, an emergency fund is your financial shield. A common goal is to save 3 to 6 months of essential living expenses. You can build it by starting small, automating your savings, and keeping the funds in a safe, separate, and accessible account like a high-yield savings account. Building this fund is one of the most empowering steps you can take. It's a tangible act of self-care for your future self. In our next chapter, we will shift our focus from defense to offense. We will begin to explore the world of debt, specifically how to understand and strategically manage it as part of your 360-degree financial plan. Hello and welcome back. So far in our journey, we have laid a solid foundation. We've created a budget to act as our financial blueprint and discussed the critical importance of an emergency fund to serve as our safety net. With these defensive measures in place, we can now turn our attention to the offensive side of the plan. We're going to tackle a topic that is a major source of stress for millions of Americans: debt. The word debt often carries a heavy weight. It can feel like a burden that holds you back from your goals. But in the world of 360 finance, our goal is not to fear it, but to understand it, and then to create a strategic plan to manage it. In the United States, debt is a common tool used to finance major life events, from getting an education to buying a home. The key is to be the master of your debt, not the other way around. First, it's helpful to understand that not all debt is created equal. A common framework in personal finance is to differentiate between what is sometimes called good debt and bad debt. Good debt is typically defined as borrowing money to purchase something that has the potential to grow in value or increase your long-term income. The most common examples are a mortgage to buy a home, which is an asset that can appreciate over time, or student loans to earn a degree, which can significantly increase your earning potential over your career. A loan to start a business could also fall into this category. The idea is that this type of debt can be a form of leverage to improve your financial position in the long run. However, a crucial note here is that even good debt can become problematic if you borrow more than you can comfortably afford or if the interest rate and terms are unfavorable. Bad debt, on the other hand, is generally used to describe borrowing money for things that lose value or are consumed immediately. The defining characteristic of this type of debt is often a high interest rate, which makes the original purchase far more expensive over time. The most prominent example is high-interest credit card debt used for everyday purchases, vacations, or consumer goods. Payday loans, with their extraordinarily high fees and interest rates, are an extreme and particularly dangerous form of this debt. The purpose of this distinction is not to make you feel bad about past decisions, but to help you classify and understand the debt you have. This understanding is the first step toward creating a powerful repayment strategy. Before we discuss strategies, we need to talk about the single most important number associated with your debt: the APR, or annual percentage rate. The APR is the price you pay each year to borrow money, including interest and any associated fees. You can think of it as the price tag on your loan. A loan with a 3% APR is far cheaper than credit card debt with a 22% APR. Knowing the APR of every single one of your debts is essential. It allows you to see which debts are costing you the most money over time, and this information will be the cornerstone of your repayment plan. Now let's explore two of the most popular and effective strategies for paying off debt. It's important to state that there is no single best method for everyone. The most effective strategy is the one that you can stick with consistently. The first strategy is called the debt avalanche. Here's how it works. You list all of your debts in order from the highest APR down to the lowest APR. You continue to make the minimum required payment on every single debt. Then, you take every extra dollar you can find in your budget and apply it aggressively to the debt with the highest interest rate. Once that debt is completely paid off, you take the entire amount you were paying on it, both the minimum payment and the extra amount, and roll it over to the debt with the next highest APR. The logic behind the debt avalanche is purely mathematical. By eliminating your most expensive debt first, you will pay the least amount of interest over the life of your loans. From a financial perspective, this method will get you out of debt the fastest and save you the most money. The second strategy is called the debt snowball. With this method, you list your debts in a different order, from the smallest balance to the largest balance, regardless of the interest rate. You make the minimum payment on everything, but you throw every extra dollar you have at the debt with the smallest balance. When that debt is paid off, you experience a quick win. This can be a huge psychological boost. You then take the full amount you were paying on that cleared debt and apply it to the next smallest balance. As you pay off each debt, the payment amount you're applying, your snowball, gets bigger and bigger, creating powerful momentum. The logic of the debt snowball is based on human behavior. Personal finance is as much about psychology as it is about math. The motivation from those early victories can be the key to staying committed to your plan for the long haul, even if it means you might pay slightly more in interest compared to the avalanche method. Neither method is right or wrong. One prioritizes math, the other prioritizes motivation. The choice depends on what you believe will work best for your personality. Finally, let's briefly touch on how managing debt connects to another important piece of your 360-degree financial picture: your credit score. In the U.S. financial system, your credit score is a number that represents your creditworthiness. Making consistent, on-time payments on all of your debts is one of the most significant factors in building a strong credit score. Furthermore, paying down balances on credit cards lowers what's called your credit utilization ratio, which can also have a positive impact on your score. A better credit score can unlock lower interest rates in the future, saving you thousands of dollars on major purchases like a car or a home. In summary, taking control of your debt starts with understanding it. Differentiate between debt that can be an investment and high-interest debt that drains your wealth. Always know your APRs, and then choose a repayment strategy, like the Avalanche or Snowball, that aligns with your personality. Managing debt is a marathon, not a sprint. Be patient with yourself, celebrate the small victories, and stay consistent. In our next chapter, we're going to make a very exciting pivot. We'll shift our focus from what you owe to what you can own, as we demystify the world of investing for beginners. Hello and welcome back. In our journey so far, we have built a strong financial foundation. We've created a budget, established an emergency fund, and developed a strategy for managing debt. Now, with our defenses in place, we can turn to a topic that is truly about building for the future. We're going to demystify the world of investing. The word investing can sound intimidating. It might bring to mind images of fast-paced stock exchanges and complex charts. But at its core, the concept is quite simple. Investing is the process of putting your money to work for you, with the goal of having it grow into a larger sum over time. Let's first clarify the difference between saving and investing. Saving, like we discussed with emergency funds, is about setting money aside in a safe, easily accessible place for short-term goals or emergencies. The primary goal of saving is preservation. Investing, on the other hand, is for long-term goals. Think 5 years or more in the future, with retirement being the most common example. The primary goal of investing is growth. This growth comes with an important trade-off, which is the foundational concept of risk and reward. Generally speaking, investments with the potential for higher returns also come with a higher level of risk, which is the possibility that you could lose money. Conversely, lower-risk investments typically offer lower potential returns. Understanding this relationship is key to building an investment approach you are comfortable with. So, how does investing actually grow your money? One of the most powerful forces in all of finance is a concept called compound interest, or compounding. Albert Einstein is famously quoted as calling it the eighth wonder of the world. Here's a simple way to think about it. Imagine you plant a small apple tree. The first year, it might produce a few apples. The next year, it produces a few more. If you take the seeds from those apples and plant them, you'll eventually have more trees, which in turn produce even more apples and more seeds. Compounding works the same way. When you invest, your money earns a return. The next year, you earn a return not just on your original money, but also on the return you earned the year before. Your money starts to earn money. Over a long period, this effect can be dramatic, causing your investment to grow at an accelerating rate. This is why time is often considered an investor's single greatest asset. The earlier you start, the more time you give your money to compound and grow. As a beginner, it's helpful to know about a few basic types of investments, or asset classes. The first is stocks, which are also known as equities. When you buy a stock, you are buying a small piece of ownership in a public company. If that company does well and its value grows, the value of your share can grow too. If the company performs poorly, the value of your share can decrease. Stocks are generally considered to have higher potential returns over the long run, but also come with higher risk and volatility. The second is bonds. When you buy a bond, you are essentially lending money to a government or a corporation. In return for your loan, they agree to pay you periodic interest payments over a set term. At the end of that term, your original investment, known as the principal, is returned to you. Bonds are generally considered to be lower risk than stocks, and can provide a more stable, predictable income stream. Most investors don't just own one stock or one bond. They often own a mix of many different investments to achieve what's called diversification. The idea behind diversification is simple. Don't put all your eggs in one basket. By spreading your money across various types of investments, you can help reduce your overall risk. Now, where do you hold these investments? In the United States, there are special types of accounts designed for investing that offer powerful tax advantages. You've likely heard of them. One common type is a 401k. This is an employer-sponsored retirement plan. You can contribute a portion of your paycheck, and often, your employer will match a certain amount of your contribution.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
This employer match is a significant benefit. Another common type is an IRA, which stands for Individual Retirement Arrangement. This is an account you can open on your own, separate from an employer. There are different types of IRAs like the traditional IRA and the Roth IRA, each with its own specific tax rules and benefits. It is critical to understand that this information is for educational purposes only and is not investment, financial, or tax advice. The world of investing is complex, and the best choices for you depend entirely on your individual financial situation, your goals, and your comfort level with risk. It is highly recommended that you conduct your own thorough research or consult with a qualified financial professional to receive guidance tailored to your specific circumstances. In summary, investing is about putting your money to work for long-term growth. It's different from saving, and it involves a balance of risk and reward. The incredible power of compounding means that time is your best friend. Understanding the basics of stocks, bonds, and tax-advantaged accounts like 401(k)s and IRAs provides a solid foundation of knowledge. Investing is the primary way that most people build wealth over their lifetime. It is the engine that will power your 360-degree financial plan toward your most ambitious long-term goals. In our next chapter, we'll take a closer look at one of the most significant of those goals: planning for retirement. Hello and welcome back. In our last chapter, we planted the seeds of long-term growth by exploring the fundamentals of investing. We discussed the power of compounding and introduced basic concepts like stocks and bonds. Today, we're going to focus that lens on one of the most significant and universal long-term financial goals: retirement. Retirement can feel like a distant, abstract concept, especially when you're just starting your career. It's easy to think, "I'll worry about that later." But as we learned with compounding, the single most valuable asset you have on your side is time. The earlier you start planning for retirement, the less work you have to do later. A small amount saved in your 20s can grow to be much larger than a much bigger amount saved in your 50s. All thanks to the magic of compounding over decades. So what is retirement planning really? At its core, it's the process of ensuring you have enough money to live comfortably after you stop working. It's about creating a future where work is optional, allowing you to spend your time pursuing hobbies, traveling, or being with family without financial stress. The goal is to build a nest egg that can generate enough income to replace the paycheck you were earning during your working years. A common question is, how much do I need to save? While the exact number is different for everyone and depends on your desired lifestyle, financial professionals often use general guidelines to help people get started. One common rule of thumb suggests you may need around 80% of your pre-retirement income to maintain a similar standard of living after you retire. This is just a guideline, of course, as your expenses may decrease in some areas, like commuting, but increase in others, like healthcare. The how of saving for retirement is just as important as the how much. As we briefly touched on in the last chapter, the U.S. government provides powerful tools to help people save for this goal in the form of tax-advantaged retirement accounts. Let's revisit and expand on the two most common types: the 401(k) and the IRA. A 401(k) is a retirement plan sponsored by an employer. A key feature of many 401(k) plans is the employer match. This is where your company contributes money to your account to match your own contributions, up to a certain percentage of your salary. For example, your company might match 100% of your contributions up to 3% of your pay. This is a powerful benefit. It is often described as a 100% return on your investment, instantly. An IRA, or individual retirement arrangement, is an account that you open and manage on your own, separate from any employer. This is a great tool for self-employed individuals, or for anyone who wants to save for retirement outside of their workplace plan. Now, for both 401(k)s and IRAs, you will often encounter two main varieties: traditional and Roth. Understanding the difference is crucial as it comes down to when you get your tax break. With a traditional 401(k) or IRA, your contributions are often tax deductible. This means the money you contribute can lower your taxable income for the current year, which is a nice immediate benefit. Your money then grows tax deferred, meaning you don't pay any taxes on the investment gains each year. The trade-off is that when you withdraw the money in retirement, those withdrawals are treated as regular income and are taxed at whatever your income tax rate is at that time. With a Roth 401(k) or IRA, the system is reversed. You contribute money that has already been taxed, there is no upfront tax deduction. The major benefit is that your money grows completely tax-free, and when you take qualified withdrawals in retirement, you pay zero federal income tax on that money. The growth and the withdrawals are tax-free. So, the choice often comes down to a simple question. Do you think your tax rate will be higher now or in retirement? There's no single right answer, and it's a personal calculation. Some people choose to use a mix of both to diversify their tax situation in their later years. Once again, it is essential to state that this is for informational and educational purposes only. Tax laws are complex and can change. This is not tax or investment advice. For guidance specific to your personal situation, it is always recommended to consult with a qualified financial advisor or a tax professional. The journey to a secure retirement is a marathon. It is built on the simple habit of consistently setting aside money in these powerful accounts and allowing it to grow over a long period. By understanding the tools available, like 401k, and IRAs, and the concepts of traditional versus Roth, you are empowered to take an active role in building the future you envision for yourself. To summarize, planning for retirement is a long-term project where starting early is your biggest advantage. The goal is to build enough savings to replace your income. Powerful tools like 401k, and IRAs offer significant tax advantages to help you reach that goal. In our next chapter, we will shift gears from long-term planning back to the present. We'll explore a topic that is a critical part of your 360-degree financial health: understanding and managing your insurance needs. Hello and welcome back. In our recent chapters, we've been focused on building wealth through investing and planning for retirement. Those are the exciting, forward-looking parts of your financial plan. Today, we're going to shift our focus back to a crucial defensive component, one that protects everything you're working so hard to build. We're talking about insurance. If you think of your financial plan as a house, insurance is the roof. It's not the most glamorous part, but without it, one bad storm could ruin everything inside. The fundamental purpose of insurance is risk management. You pay a predictable, regular amount, called a premium, to an insurance company. In exchange, they agree to take on the financial risk of a specific, unpredictable, and potentially catastrophic event. It's a shield that protects your savings and your future from being wiped out by a major setback. In the 360 finance approach, having the right insurance coverage is non-negotiable. It's the safety net that allows you to confidently invest and save for the long term. Let's walk through some of the most common and important types of insurance in the United States. First, and perhaps most essential, is health insurance. Medical costs in the U.S. can be extraordinarily high. A single serious illness or a major accident could lead to bills totaling tens or even hundreds of thousands of dollars. Health insurance is designed to cover a significant portion of these costs, including doctor visits, hospital stays, prescription drugs, and preventive care. Without it, a medical emergency can quickly become a financial catastrophe, forcing people into debt or bankruptcy. Next is auto insurance. If you own and operate a vehicle, this is not just a good idea. In nearly every state, it is required by law. At a minimum, you need liability coverage, which pays for damages to other people's property and their medical expenses if you cause an accident. You can also get collision coverage, which pays to repair your own car after an accident, and comprehensive coverage, which protects against non-accident-related events like theft or storm damage. Another cornerstone of a solid financial plan is life insurance. This is a topic that can be difficult to think about, but it's incredibly important, especially if you have a spouse, children, or anyone else who financially depends on your income. Life insurance provides a tax-free lump sum payment, known as a death benefit, to your designated beneficiaries after you pass away. This money can be used to replace your lost income, pay off a mortgage, fund a child's education, or simply cover final expenses. For beginners, it's helpful to know about the two most basic categories. Term life insurance covers you for a specific period, or term, such as 10, 20, or 30 years. It is generally the most affordable and straightforward option. Permanent life insurance, such as whole life, provides coverage for your entire lifetime, and typically includes a cash value component that can grow over time. We also need to talk about protecting your most valuable asset. It's not your house or your car, it's your ability to earn an income. This is where disability insurance comes in. If an illness or injury prevents you from working for an extended period, disability insurance can replace a portion of your lost income. This allows you to continue paying your bills and supporting your family while you recover. It's a vital, yet often overlooked, form of protection. Finally, if you own a home or rent an apartment, you'll need homeowners or renters insurance. Homeowners insurance covers damage to the structure of your house as well as your personal belongings inside from events like fire or theft. It also includes liability protection in case someone is injured on your property. Renter's insurance doesn't cover the building itself, but it does protect your personal possessions within your rented space, and also provides liability coverage. It's very important that you understand the following. This has been a general overview for educational purposes only. This is not legal or financial advice. The world of insurance is complex, and the right types and amounts of coverage are highly personal. They depend on your age, health, family situation, income, and many other factors. To make informed decisions, it is essential to speak with a licensed insurance professional who can assess your individual needs and provide specific recommendations. In summary, insurance is the protective shield for your financial life. It transfers the risk of catastrophic financial loss from you to an insurance company. Health, auto, life, disability, and property insurance are the key pillars that protect you, your family, and your assets, giving you the peace of mind to build for the future. In our next chapter, we will address another major financial milestone that is a goal for many Americans: the process of buying a home. Hello and welcome back. In our last chapter, we talked about building a protective shield around your finances with insurance. Today, we're going to explore one of the biggest financial milestones in many Americans' lives: buying a home. For many, homeownership is a core part of the American dream. It can be a place to build a life, raise a family, and over the long term, build wealth. The home buying process can seem complex and even intimidating for a beginner, but by breaking it down into key concepts, you can navigate it with confidence. This chapter will serve as a high-level educational overview of the journey. Before you even start looking at houses online, the first step is to look at your own financial situation. Lenders will be looking closely at a few key areas. The first is your credit score. As we've touched on previously, this 3-digit number is a summary of your credit history. A higher credit score generally signals to lenders that you are a responsible borrower, which can help you qualify for a loan and, most importantly, secure a lower interest rate. A lower interest rate can save you tens of thousands of dollars over the life of your loan. The next crucial piece is the down payment. This is the portion of the home's purchase price that you pay up front in cash, rather than financing it through a loan. A common guideline you may hear is to put down 20% of the home's value. Putting down 20% often allows you to avoid paying something called private mortgage insurance, or PMI, which is an extra fee added to your monthly payment that protects the lender in case you can't make your payments. However, it's important to know that many loan programs, especially for first-time homebuyers, allow for much smaller down payments, some as low as 3 to 5%. While a smaller down payment can get you into a home sooner, it typically means a larger loan and a higher monthly payment. Once your finances are in order, the next logical step is getting pre-approved for a mortgage. A mortgage is simply a long-term loan used to buy a house. A pre-approval is different from a pre-qualification. A pre-qualification is a quick estimate of what you might be able to borrow. A pre-approval, on the other hand, is a much more formal process. A lender will thoroughly review your income, assets, debt, and credit history, and provide you with a letter stating that they are conditionally willing to lend you a specific amount of money. This pre-approval letter is incredibly powerful. First, it tells you exactly how much house you can realistically afford, which allows you to focus your search in the right price range. Second, it shows sellers and real estate agents that you are a serious, qualified buyer, which can give you a significant advantage when you're ready to make an offer. With a pre-approval in hand, you can begin the exciting part: searching for a home. Once you find one you love and your offer is accepted, the closing process begins. This period typically lasts 30 to 45 days, and involves several important steps like a home inspection to check for any major issues and a home appraisal to ensure the property is worth the price you've agreed to pay. Finally, it's important to remember that the cost of homeownership goes far beyond the monthly mortgage payment. From a 360-degree financial perspective, you must also budget for ongoing expenses. These include property taxes, which are paid to your local government, homeowners insurance, which we discussed in the last chapter, and potentially HOA fees if you live in a planned community. And of course, there's maintenance and repairs. Unlike renting, when a faucet leaks or an appliance breaks, the cost of fixing it is your responsibility. Please remember, this overview is for informational and educational purposes only, and does not constitute financial or real estate advice. The process of buying a home involves significant legal and financial commitments. It is essential to work with a team of qualified professionals, including a licensed real estate agent and a reputable mortgage lender, who can provide expert guidance based on your personal situation and local market conditions. In summary, preparing to buy a home starts with strengthening your financial profile, particularly your credit score and down payment savings. Getting pre-approved for a mortgage gives you a clear budget and makes you a stronger buyer. Finally, remember to account for the total costs of ownership, not just the mortgage payment, in your long-term financial plan. In our next chapter, we'll shift our focus to another key aspect of your financial life in the United States: understanding the basics of income taxes. Hello and welcome back. In our 360 finance journey, we've covered earning, saving, borrowing, investing, and protecting your assets. Now we're going to tackle a topic that affects nearly every dollar you earn: income taxes. Taxes can seem incredibly complex, and for many, the process can be a source of anxiety. The goal of this chapter is not to make you a tax expert, but to provide a foundational, educational overview of the U.S. income tax system, so you can understand the basic principles at play. First, what is income tax? It's a tax levied by federal, most state, and sometimes even local governments on the income you generate. This includes money you earn from a job, known as wages, as well as income from investments or self-employment. The revenue collected from these taxes is used to fund public services that benefit society, such as roads, schools, national defense, and social programs. In the United States, the system is pay-as-you-go, which is why your employer typically withholds a portion of your pay for taxes from each paycheck. To understand how taxes are calculated, we need to know a few key terms. The starting point is your gross income. This is all the money you receive during the year before any taxes or other deductions are taken out. From there, certain adjustments can be made to arrive at your adjusted gross income, or AGI. These adjustments, sometimes called above-the-line deductions, might include contributions to a traditional IRA or student loan interest payments. Your AGI is a very important number, as it's often used to determine your eligibility for certain tax benefits. Next, we get to the core of reducing your tax bill: deductions and credits. These two terms are often confused, but they work very differently. A tax deduction is an amount of money that you can subtract from your adjusted gross income to lower the amount of your income that is subject to tax. Think of it as a discount on your income. In the US, you have two choices. You can take the standard deduction, which is a fixed dollar amount that changes each year, or you can itemize deductions. If you itemize, you list out all your individual deductible expenses, such as mortgage interest, state and local taxes, and charitable contributions. You would choose whichever method, standard or itemized, results in a larger deduction. A tax credit is even more powerful. While a deduction reduces your taxable income, a credit directly reduces your tax bill, dollar for dollar. For example, a $1,000 tax credit is more valuable than a $1,000 tax deduction. The credit reduces your final tax bill by the full $1,000. The deduction only reduces your bill by an amount equal to your tax rate times the deduction. After you've subtracted your deductions from your AGI, you're left with your taxable income. This is the amount your tax is actually calculated on. But how is it calculated? The U.S. federal income tax system is what's known as a progressive tax system. This means that higher levels of income are taxed at higher rates. This is done through a system of tax brackets. Here's how it works conceptually. Everyone's income is divided into tiers, or brackets. The first portion of your income is taxed at the lowest rate. Once you've filled up that bracket, the next portion of your income is taxed at the next highest rate, and so on. A common misconception is that if you move into a higher tax bracket, all of your income is taxed at that higher rate. That is not correct. Only the money that falls within that higher bracket is taxed at the higher rate. This is a very important disclaimer. Tax laws are extremely complex, subject to change, and are based entirely on your individual and specific circumstances. This information is for general educational and informational purposes only. It is not, and should not be considered, legal or tax advice. It is absolutely essential to consult with a qualified tax professional, such as a certified public accountant, CPA, or a licensed tax preparer, who can provide advice and guidance tailored to your personal financial situation. In summary, the U.S. tax system is a pay-as-you-go system where governments collect tax on your income to fund public services. The amount you owe is based on your taxable income, which is calculated after taking deductions. The tax itself is calculated using a progressive system of tax brackets. And remember, tax credits are a dollar-for-dollar reduction of your tax bill. Understanding these basic concepts is a key part of your 360-degree financial literacy. In our next chapter, we will explore the important topic of building and maintaining a good credit score. Hello and welcome back to our comprehensive look at 360 Finance. We've journeyed through budgeting, saving, debt, and taxes. Today, we're going to focus on a three-digit number that has a surprisingly large impact on your financial life in the United States. Your credit score. Think of it as your financial reputation, condensed into a single number. So, what exactly is a credit score? It's a number, typically ranging from 300 to 850, that is designed to predict your creditworthiness. In simple terms, it helps lenders decide how likely you are to pay back a loan on time. This score is generated by scoring models that analyze the information in your credit report. A higher score indicates to lenders that you are a lower risk, while a lower score suggests a higher risk. Why is this number so important? A good credit score can unlock many financial opportunities and save you a significant amount of money. Lenders use it to decide whether to approve you for a mortgage, an auto loan, or a credit card. It also heavily influences the interest rate you'll be offered. A higher score can mean a lower interest rate, which translates to lower monthly payments and less money paid over the life of the loan. In some cases, landlords, insurance companies, and even potential employers may look at your credit information. To understand your score, you need to know what goes into it. While the exact formulas are proprietary, the major credit scoring models, like FICO, are transparent about the key factors they consider. The single most important factor, making up about 35% of a FICO score, is your payment history. This is a record of whether you have paid your bills on time. A consistent history of on-time payments is the best way to build a strong score. Conversely, late payments, or having an account sent to collections, can significantly damage it. The second most important factor, accounting for about 30%, is amounts owed, and a key part of this is your credit utilization ratio. This sounds complicated, but the concept is simple. It's the percentage of your available credit that you are currently using on revolving accounts like credit cards. For example, if you have one credit card with a $10,000 limit and a balance of $3,000, your utilization ratio is 30%. A lower utilization ratio is better. High utilization can suggest to lenders that you are overextended and may have trouble making payments. Next, making up about 15%, is the length of your credit history. Generally, a longer credit history is better. This factor considers the age of your oldest account, your newest account, and the average age of all your accounts. This is one reason why it can be wise to keep old, well-managed credit card accounts open, even if you don't use them often. The final two pieces are new credit and credit mix, each accounting for about 10%. New credit refers to recently opened accounts or recent inquiries when you apply for credit. Opening several new accounts in a short period can sometimes be seen as a risk. Credit mix refers to the variety of credit accounts you have, such as credit cards, student loans, an auto loan, and a mortgage. Having experience with different types of credit can be a positive factor. It's also important to understand the difference between a credit score and a credit report. Your credit report is the detailed document that contains all the underlying data, your list of accounts, payment history, and public records. Your credit score is the three-digit number calculated from that data. You are legally entitled to a free copy of your credit report from each of the three major credit bureaus, Equifax, Experian, and TransUnion, every year. It is a very good habit to review these reports to check for errors and to understand your financial history. This information is for educational purposes only and is not financial advice. Credit scoring models are complex, and your score can be influenced by many different factors. The general principles discussed here are widely accepted as best practices for building and maintaining a healthy credit profile. In summary, your credit score is a vital part of your financial life in the U.S. It is primarily built upon a foundation of on-time payments and responsible management of your available credit. By understanding the key factors that influence your score, and by regularly reviewing your credit reports, you can take proactive steps to build and protect your financial reputation. In our next chapter, we will discuss how to align all these financial components with your personal values and set meaningful, achievable financial goals. Hello and welcome back. Over the past 10 chapters, we have assembled an incredible toolkit. We've learned about budgeting, emergency funds, debt management, investing, insurance, taxes, and credit scores. We have all the technical pieces. But today we're going to talk about the most important part of the entire 360 finance concept, the why. We're going to discuss how to give all those numbers a purpose by setting meaningful financial goals that are deeply connected to your personal values. Financial planning without a purpose is just an exercise in spreadsheets. It's like having a car with a full tank of gas and a perfectly tuned engine, but no destination in mind. You might drive around, but you'll never actually get anywhere. Your personal values, the things that are most important to you in life, are your destination. Your financial plan is simply the vehicle to get you there. So, the very first step is to take a moment and think about what truly matters to you. Is it security, and the peace of mind that comes with knowing you're protected from the unexpected? Is it freedom, the ability to choose your own path without being tied to a job you don't love? Perhaps it's family, and you want to provide for your children's education or create lasting memories through travel. Or maybe it's generosity, and your goal is to support causes you believe in. When you connect your daily financial habits to these deep-seated values, everything changes. Saving money is no longer about deprivation. It's about buying your future freedom. Paying off debt is no longer a chore, it's an act of creating security. This connection provides the powerful, intrinsic motivation you need to stick with your plan for the long haul. Once you know your why, the next step is to translate those values into concrete goals. A vague dream like, "I want to be financially secure," is a great starting point, but it's not an actionable plan. To make it actionable, we can use a popular and effective framework known as SMART goals. SMART is an acronym that stands for specific, measurable, achievable, relevant, and time-bound. Let's break down what each of these means. First, your goal must be specific. Instead of "I want to save for a down payment," a specific goal would be, "I want to save $20,000 for a down payment on a home." Clarity is key. Second, your goal must be measurable. You need to be able to track your progress. If your goal is to save $20,000, you can measure your progress each month as your savings balance grows. This helps you stay motivated. Third, the goal must be achievable. This means it needs to be realistic given your current financial situation. If you only have $100 of positive cash flow in your budget each month, a goal to save $20,000 in 1 year isn't achievable. Your goals should stretch you, but not be so far-fetched that you become discouraged and give up. Fourth, it must be relevant. This brings us back to your why. Does this goal actually matter to you? If homeownership and stability are core values, then saving for a down payment is highly relevant. If freedom and travel are your top priorities, maybe a more relevant goal would be saving for a 1-year trip. The goal has to align with your values to be truly motivating. Finally, your goal must be time-bound. It needs a deadline. I will save $20,000 for a down payment within the next 4 years. This creates a sense of urgency and provides a clear timeline for your plan. Let's see it all come together. A vague goal like, "I want to pay off my credit card debt," becomes a SMART goal when you rephrase it as, "I will pay off my $5,000 credit card balance," specific, measurable, by paying an extra $210 per month for 24 months, achievable, time-bound, in order to achieve the peace of mind that comes with being debt-free, relevant. This information is for educational purposes only, and is not financial advice. The process of setting goals is deeply personal, and the examples provided are for illustrative purposes. A qualified financial professional can help you create a personalized roadmap based on your unique circumstances and aspirations. In summary, the engine of your financial plan is not just the numbers, but the why behind them. By identifying your core values and using the SMART framework to create specific, measurable, achievable, relevant, and time-bound goals, you transform a simple budget into a powerful tool for building a life you truly value. In our next chapter, we will explore some common financial mistakes and discuss the behavioral biases that can lead us to make them. Hello and welcome back. In our journey so far, we have built a logical, step-by-step framework for managing your finances. We've created a 360-degree plan. But there's a powerful and often unpredictable variable we need to discuss: human psychology. We are not robots. Our decisions, especially about money, are frequently driven by emotions, instincts, and mental shortcuts. This is the fascinating field of behavioral finance, which studies how our human nature can cause us to stray from a perfectly rational financial plan. Understanding these common tendencies doesn't mean you can eliminate them, but it gives you the power to recognize them in yourself and make more conscious, deliberate choices. Let's explore a few of the most common behavioral biases that can lead to financial mistakes. First is overconfidence bias. This is the tendency to believe that we are smarter and more skilled than we actually are. In finance, this often shows up as someone thinking they can consistently pick winning stocks or perfectly time the market, buying right before it goes up and selling right before it goes down. While confidence is a good thing,
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
Overconfidence can lead to taking on too much risk, failing to diversify, and trading too frequently, which can hurt long-term returns. Next is a very powerful one: loss aversion. Psychologically, the pain of losing $1 feels about twice as strong as the pleasure of gaining $1. This intense fear of loss can lead to irrational decisions. For example, it might cause someone to hold on to a losing investment for far too long, hoping it will come back to even, because selling it would mean accepting a painful, concrete loss. On the flip side, it can cause people to sell their winning investments too early, just to lock in a small gain and avoid the risk of it turning into a loss. Then we have the herd mentality. Humans are social creatures, and we have a natural instinct to follow the crowd. In investing, this can be dangerous. When a particular stock or asset is getting a lot of hype and its price is soaring, the herd mentality creates a fear of missing out, or FOMO, causing people to pile in at the peak. Conversely, when the market takes a downturn and panic sets in, the herd rushes to sell, often at the worst possible time. A disciplined financial plan helps you resist the urge to follow the herd. Finally, there's confirmation bias. This is our tendency to seek out and favor information that confirms what we already believe, while ignoring information that challenges our views. If you are excited about a particular investment, confirmation bias might lead you to only read positive articles about it and dismiss any negative reports as noise. This creates an echo chamber that reinforces your initial decision, preventing you from seeing the full, objective picture. So how do you protect your financial plan from these very human tendencies? One of the most effective strategies is automation. By setting up automatic contributions to your retirement account or an investment fund each month, you take the emotion out of the decision. The investment happens regardless of whether the market is up or down, helping you avoid the pitfalls of overconfidence and herd mentality. Another powerful tool is to create your own rules-based plan. Before you ever invest, you can write down your goals, your strategy for diversification, and the conditions under which you would sell an investment. Having these rules in place before your emotions get involved can act as a critical guide during periods of market stress or excitement. It is very important to note that this information is for educational purposes only, and is not financial or psychological advice. These concepts are general principles from the field of behavioral finance, and are intended to promote awareness. In summary, we are all susceptible to behavioral biases that can negatively impact our financial decisions. By understanding concepts like overconfidence, loss aversion, and herd mentality, we can become more mindful of our own thought processes. Building systems like automation and following a predetermined plan can help insulate your 360-degree financial strategy from short-term emotional reactions, keeping you focused on your long-term goals. In our next chapter, we'll talk about the importance of regular financial checkups and how to adjust your plan as your life changes. Hello and welcome back. Throughout this series, we have carefully constructed the components of a 360-degree financial plan. We have a budget, a savings strategy, a debt management plan, and a long-term investment philosophy. But a financial plan is not a static document that you create once and then file away forever. It's a living, breathing roadmap that needs to grow and adapt right alongside you. Think of it like regular maintenance for your car, or an annual checkup with your doctor. You do these things to ensure everything is running smoothly, and to catch any potential issues before they become major problems. A financial checkup serves the exact same purpose for your money. It's a dedicated time to review your progress, reassess your goals, and make sure your plan still aligns with your life. A common question is, how often should you do this? While there's no single right answer, a helpful rhythm can be a brief monthly check-in and a more in-depth annual review. Your monthly check-in is quick. It's about spending 15 to 30 minutes to simply review your budget, track your spending, and make sure you're on track with your short-term savings goals. This keeps you engaged with your plan and prevents small issues from snowballing. Your annual review, however, is a deeper dive. This is where you zoom out and look at the big picture. Here are some key areas to cover during your annual financial checkup. First, revisit your goals. Are the SMART goals you set a year ago still relevant? Perhaps you've achieved one, or maybe your priorities have shifted. Life changes, and your goals should reflect your current values and aspirations. Adjust them as needed. Second, review your budget and cash flow. Look at your income and spending over the past year. Did you earn more? Did your expenses increase in a certain category? Acknowledging these changes allows you to create a realistic budget for the year ahead, rather than working from outdated numbers. Third, check your net worth. Your net worth is a snapshot of your financial health, calculated by subtracting your liabilities, what you owe from your assets, what you own. Tracking this number year over year is a fantastic way to see the tangible results of your saving and investing efforts. Fourth, assess your investment performance. This is not about making panicked reactions to short-term market fluctuations. It's a high-level review to ensure your overall investment mix still aligns with your long-term goals and risk tolerance. Are your contributions on track for your retirement goals? Fifth, review your insurance coverage. As we discussed, insurance is your financial shield. Did you have any life changes that might require an update to your coverage? We'll discuss this more in a moment. And sixth, check your credit report. As we learned, you're entitled to a free report from each of the 3 main bureaus annually. Pulling one of these reports during your annual review is a great habit to ensure there are no errors and to monitor your overall credit health. Beyond these scheduled reviews, certain major life events should always trigger an immediate financial checkup. These events can fundamentally change your financial picture and require significant adjustments to your plan. For example, getting married. Now you are likely merging financial lives with a partner. This requires open conversations about joint goals, shared budgets, and updating account beneficiaries. Having a child is another huge one. This brings new expenses, the need to start saving for education, and critically, the immediate importance of getting or increasing life insurance coverage. Changing jobs or getting a significant raise also calls for a review. A new job might mean a new 401k plan to understand, and a raise provides a perfect opportunity to increase your savings and investment contributions before that extra money gets absorbed into your lifestyle. Buying a home, as we discussed, completely changes your monthly expenses and liabilities, requiring a major update to your budget. This information is for educational purposes only. It is not financial advice. A qualified financial professional can provide personalized guidance on how to adjust your plan based on your unique life events and financial situation. In summary, your financial plan is not a monument carved in stone. It's a dynamic roadmap. By conducting regular checkups and reassessing your plan after major life events, you ensure that it remains a relevant and powerful tool that is always working to serve your current and future self. In our next chapter, we will delve into the topic of estate planning, what it is and why it's an important consideration for everyone, not just the wealthy. Hello and welcome back. As we near the end of our 360 Finance series, we've covered nearly every aspect of managing your financial life. Today, we're going to address a topic that is often misunderstood and sometimes avoided, but it represents one of the most thoughtful and caring parts of a truly comprehensive financial plan. We're talking about estate planning. When you hear the term estate planning, you might think it's something reserved only for the very wealthy with large, complicated estates. But that is a common misconception. The truth is, if you are an adult, you have an estate. Your estate is simply everything you own: your car, your bank accounts, your investments, your home, and your personal possessions. Estate planning, therefore, is the process of creating a plan for how those assets will be managed and distributed after you pass away. But it's about more than just your money. A good estate plan also includes instructions for your care if you become unable to make decisions for yourself. At its heart, estate planning is not about death. It's about taking care of yourself and the people you love. It's an act of responsibility and a final gift to your family, designed to make a difficult time much easier for them. Let's discuss some of the key components of a basic estate plan in a purely educational context. The most well-known document is a last will and testament, or simply a will. A will is a legal document that outlines your wishes. It specifies who you want to receive your property. It also allows you to nominate a guardian for any minor children, which is one of the most critical reasons for any young parent to have a will. It's important to understand, however, that a will doesn't control everything. This leads us to another crucial component: beneficiary designations. For many of your most significant financial accounts, like your 401k, your IRA, life insurance policies, and other investment accounts, you name a beneficiary directly on the account itself. These designations are incredibly powerful. In most cases, they will override whatever is written in your will. This is why it is absolutely essential to regularly review your beneficiary designations, especially after major life events like a marriage, divorce, or the birth of a child. Estate planning also involves planning for potential incapacity. What happens if an illness or injury leaves you unable to manage your own affairs? Two key documents address this. A durable power of attorney for finances is a legal document where you name a trusted person, often called an agent, to make financial decisions on your behalf if you cannot. This person could pay your bills, manage your bank accounts, and handle other financial matters to ensure your life continues to run smoothly. Similarly, a healthcare power of attorney or medical proxy allows you to designate someone to make medical decisions for you if you are incapacitated and unable to communicate your wishes. This document ensures that healthcare decisions are made by someone you trust who understands your values. So what happens if you don't have a plan? If you pass away without a will, it is called dying intestate. In this situation, your state's laws will determine how your assets are distributed. The court will appoint someone to manage your estate, and your property will be divided according to a predetermined legal formula. This formula may not align at all with what you would have wanted. Creating an estate plan ensures that your wishes are known and can be followed. This is the most important part of this chapter, and we cannot stress it enough. This information is for general educational and informational purposes only. It is not legal advice. Estate planning laws are incredibly complex and vary significantly from state to state. It is absolutely essential to consult with a qualified estate planning attorney in your state. Only a licensed attorney can provide you with legal advice and help you create legally valid documents that are tailored to your specific family situation and financial circumstances. In summary, estate planning is a critical component of a comprehensive 360-degree financial plan for all adults. It's about ensuring your assets go to the people you choose, naming a guardian for your children, and planning for your own care. By creating a plan, you provide clarity, reduce potential conflict, and lift a significant burden from your loved ones. In our final chapter, we will bring everything together and discuss how to move forward with confidence on your lifelong financial journey. Hello and welcome back for the final chapter of our series. We began this journey with a simple question: what is 360 finance? Over the course of 15 chapters, we have explored that question from every angle. We've journeyed from the basics of budgeting and saving to the complexities of investing, insurance, and planning your legacy. If finance once felt like an intimidating, disconnected puzzle, our goal has been to help you see it as one complete, manageable picture. Today, we're going to bring everything together. We'll revisit the core philosophy of 360 finance and leave you with a few key principles to carry forward on your lifelong financial journey. The 360 finance approach, at its heart, is a mindset. It's the understanding that your financial life is an interconnected ecosystem. Your budget affects your ability to save. Your debt level impacts your capacity to invest. Your insurance protects all of your assets, and your long-term goals give every financial decision a purpose. You can no longer see these as separate tasks, but as integrated parts of a single, personal system. We've built this system piece by piece. We laid the foundation with a budget and an emergency fund. We learned to strategically manage debt and build a positive credit history. We demystified the world of investing, planting the seeds for long-term growth through retirement planning. We shielded our progress with the right insurance and navigated major life milestones. And we planned for the future with an understanding of taxes and estate planning. You now have the blueprint. As you move forward from this series, I want to distill all of this information into a few simple, guiding principles for lasting success. First, live intentionally. This is your why. Remember that the ultimate goal of a financial plan isn't just to accumulate money. It's to fund a life that aligns with your values. Before making a significant financial decision, ask yourself, does this move me closer to the life I want to live? This simple question can bring incredible clarity. Second, automate your success. We learned about the power of our own psychology and how emotions can lead us astray. The single best way to counteract this is to put your progress on autopilot. Automate your savings contributions. Automate your retirement investments. Automate your extra debt payments. When you pay yourself first, automatically, you are ensuring that your most important financial goals are being funded consistently, without you having to think about it. Third, play the long game. Meaningful financial progress is a marathon, not a sprint. It is built not on one or two brilliant moves, but on thousands of small, consistent, and disciplined decisions made over decades. Embrace the power of patience. Trust in the process of compounding. Don't be swayed by short-term market noise or get-rich-quick schemes. True wealth is built slowly and deliberately. And finally, stay curious and keep learning. This series is a foundational starting point, not an endpoint. The world of finance is always evolving. New laws are passed, and your own life will continue to change. Commit to being a lifelong learner. Read books, listen to podcasts from reputable sources, and stay engaged with your finances. The time you invest in your own financial literacy will pay the best dividends of all. This brings us to our final, and perhaps most important, reminder. This entire series has been created for informational and educational purposes only. We have explored concepts, frameworks, and general principles. We have not provided any financial, investment, legal, or tax advice. Your financial situation is unique. The goal of this series was not to give you all the answers, but to empower you to ask the right questions and to have more confident, productive conversations with qualified professionals. Building a team that includes a certified financial planner, a certified public accountant, or an estate planning attorney is not a sign of weakness. It is one of the smartest financial decisions you can make. You have taken an incredible step by investing your time to learn these concepts. You are now equipped with the knowledge to take control of your financial narrative. You have the tools to build a plan that is resilient, purposeful, and uniquely your own. The journey to financial well-being is now yours to walk, with clarity and with confidence. Thank you for joining me on this journey through the world of 360 finance.
Disclaimer. The information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.